But not everyone is convinced. So what's the answer? Should you sell or should you stay? Here now with a closer look at both sides, we have Keith Springer, president of Springer Financial Advisors, and Marshall Auerbach, global portfolio strategist for Madison Street Partners and a senior fellow at the Roosevelt Institute. I've got to start with the bull. Keith, we've had this huge rally against all odds. Oh, you know what? Let's start with the bear. Because I don't know, Marshall, let's start with you because finally the market's starting to look a little vulnerable. Okay, we got you guys both back up. But Marshall, we'll start with the bear instead. We're looking a little vulnerable here. Nevertheless, you know, there have been so many calls for the demise of this rally, and every time it looks like we're going to correct, we don't. Why do you think this is the time we finally do cave in?
Well, cave-in might be a bit strong, Charles. First of all, thanks for having me on the show. What I would say is that you're just getting a lot of signs of mounting economic signs of weakness across the globe, not just here in the U.S. You had a very bad ISM number the other day. It's volatile, but it certainly wasn't good. You've had a poor weekly jobless claims number, which does indicate that maybe you're starting to see some deterioration on the employment front. Internationally, it's been a disaster. The Eurozone looks absolutely awful. German factory orders are plunging, as did German retail sales. So you're starting to see the disease of the periphery countries, the so-called problems of the pigs, are now extending into core Europe. China appears to be slowing down, and we all know about the disaster that afflicted Japan. So you add that together, and I think it makes for a much more problematic environment for financial assets in the second half this year.
Keith, Marshall makes great points. There's absolutely no doubt this proverbial wall of worry is a million miles high, and yet the market rally continues, and you think it's not going to stop.
Now, there's a main reason, Charles. It's because of the stimulus being put in by the government. They announced the end to QE2, but they essentially continue with a QE, almost like a QE mini-me, I'm calling it, because although it's not 110 billion a month, it's still 30 or 40 billion. The stock market is addicted to this stimulus. It's addicted to this quantitative easing type programs. And as long as the government continues to put money into this market, stocks are going to go up. I recognize the problems we've had, but the market always climbs a wall of worry. We've known about these problems. Yes.
How does the stimulus impact the stock market? In other words, we hear it all the time. People talk about it. Is there some sort of direct manipulation of the market with the money that the Fed is printing? How do you get the money from the Fed to prop up stocks?
That's an excellent question, and it's something that probably can't be discussed in just a few seconds. But primarily, the government does two things. One is it issues money, and the money goes into the Federal Reserve, and the money goes into the bank reserves to allow banks to lend more. But it also gives the government a lot of money every month to do what with? It pays unemployment benefits, it pays social programs, and it gives it out and spends money in the economy and in the market. It also directly affects and directly benefits some of the investment banks because these investment banks get to buy bonds ahead of the Fed knowing they're coming, and it puts a lot of money into the economy, but primarily into the hands with people who already have the money. And what do people who already have the money do? They typically buy stocks. Money chases the stocks that are moving, which is why recently you've seen everything move. You've never seen before commodities go up. You've never seen gold go up, oil, silver, and the stock market. It used to be if the stock market went up, oil had to go down and vice versa. So lately we've had a rush of money.
Let's bring Marshall back in here. Marshall, the bear argument seems like a common sense argument, but by the same token, we're in the middle of earnings season, and these earnings have been fantastic. You could easily argue that valuations, 14 times PE, that's not a lot. So there are some legitimate reasons for this rally to continue. If someone was asking you right now, should I stay out of the market for a long period of time, or should I buy in knowing that there could be a short-term blip, what would you tell them?
Well, frankly, I don't think there is going to be, the indices are going to have a very hard time making headway from here. It wouldn't surprise me if we had another 5% blip, but bear in mind, you're talking about a market that hasn't corrected significantly since 666 at the March 2009 lows. It wouldn't be surprising to me to see a 20 to 25% correction over the next 8 to 12 months. As far as the other points that Keith has made, quantitative easing actually does nothing for the economy. The banks can't actually lend reserves. Reserves are there only for interbank lending. That's a common misconception. All the Federal Reserve does is it buys treasuries and replaces them in the banking system with reserves that yield 2.25%. The thing that's actually enhanced economic strength has been fiscal policy, and that's being wound down. You're getting fiscal retrenchment. You already discussed the debt limits, and that's going to affect the economy adversely in the future.
Marshall, fantastic points. I got to say thanks and goodbye. We haven't solve the
Thank
debate.
you.
Some people are going to come away from this thinking buy in May. Some are going to go hide under a rock. Keith Springer, Marshall Araback, thank you very much.